All right. Good morning, everybody. Got a little bit of tariff news over the weekend. Seems like electronics are getting a little bit of a reprieve in the short term. He did say that it's likely to change, but for the time being, seems like they get a bit of an exemption from the really big 120 or 150 or whatever it is against China. Electronics will be exempt from that. In the same conversation over the weekend, he said something about chips. At the moment, chips are looking pretty good, not as horrible as they could be. And that included Dell too. Um, Apple, Dell, MU. Check the list. A number of them were up this morning. And then Pfizer was down, but I think it went red to green. So looking at what's going on around the world, the markets just seem to be holding the line, keeping it green at the moment. Small caps up about 1%. The NASDAQ up 1.75%. We've got a lot of Fed speakers today, and we're going to get some inflation. It's not inflation data per se, but we are going to get some inflation insight. We've got auctions in the front end as well, and that should wrap us up for the day, other than any afternoon headline stuff. And for the afternoon, you can see all these Fed speakers later in the day, 5 o'clock, 6:45, closer to 7 really. But the NY Fed inflation expectations, we've seen this one move markets. Just keep in mind, this isn't inflation data, right? This is different. Inflation expectations, which, don't get me wrong, it still has impact. It's just you're on the other side of the coin. Dollar still below 100, seems to be leaning on trip lower. The big move we saw in the 10-year last week continues to unwind. And I think everybody's still in agreement that watching treasuries is still your best bet at this point. Just trying to keep an eye on it, make sure nothing breaks. And that if it does, then you're watching the thing that's likely to tell you that things are going to go wrong really fast. We're back above the 10-day and the 3-day. Now all we need is for the 3-day to cross above the 10, which would happen tomorrow. If you kind of get that idea on a daily, price crosses the 3 and the 10, and then the 3 crosses the 10, and this is what we call a surge signal. We've been holding underneath this 20-period moving average on the daily since February. And sure, we've tested it, popped above it for brief periods of time, haven't been able to keep it. So one of the things we want to see this week is a breakout of last week's high, which would put us above the 20-period moving average. Close above it with enough conviction or strength, whatever way you want to say it. Get this gap closed, get above that, and then work on the 50-period moving average. And of course, along the way, we've got cog lines, solid round numbers. We've got options levels, zero gamma, volatility trigger, call wall. There's a lot of things in the way. We got not only the 20-day, but the 10-week is over our head as well. But that's at 5611 cog line. So if we are working on our way back up, we've got a lot of stuff to work through. Now, whether or not you want to count that as a high or low is really up to you at this point. I think the best way to do this is just to put it into a line chart. So we'll go ahead and count it, call that a high or low. We need to break this high and set a higher high. After we set that higher high, we need to pull back and set another higher low. Right? We're not looking for some rocket ship to take us back up into 6,200. It would be unsustainable and we'd likely give it all back up again. The ADR lines are really spread out after the moves we've seen recently, but they still are an indication of what we've been doing, right? This is based on what the market has done over the last month. It's a 21-day average daily range. The key to all of that is what it has been doing, right? This is something that you can adjust for different time frames. You could put it on a 1 week, a 2 week. You could do the entire year. 1 month is enough for me. I kind of like it at that setting, but there's no magic to a 21-day range. You can measure whatever you want. For the downside, now that we're already outside of last week's Friday close and Friday's range, we've got an inside day breakout. We need to keep that. So we're closer to the upper one. And to even get to the lower one, we would have to break back inside of the previous day's range to do it. Which means it's more likely that we hit the upper edge rather than hitting the lower edge. But we don't have to hit either side. That's part of the argument to be made because of how wide the range is now. If volatility is starting to back off a little bit, and volatility in this way isn't necessarily pointing towards a gauge like the VIX or some other volatility indicator. It's more of the idea of what is volatility. Volatility is a nerd word for movement. So if we're moving a lot, then we've got a lot of volatility. Implied is another word for promised, right? So you put the two together, implied volatility is promised movement. So if we're not moving as much, if volatility is backing off, it's likely we don't hit either line. And if we're waiting on data, it's also likely we don't hit either line. It's a short week this week, which does make it a little bit of a threat for the kind of moves that we could see this week. Markets make some of their biggest moves in low volume conditions. And on a short trading week, it's often that we see low volume conditions. This is OPEX week. It'll be on the 17th instead of the 18th because of the holiday. But because it's OPEX week, it's very likely that the market maker move signal that we generally look for won't work very well. And that's because if they're trading in the front end to roll out things that are going to be expiring, it's going to jack up that market maker move. It'll give a false signal. This happens every OPEX, so it's not a surprise. It's not new, right? It's just something to warn against. So even if we do have a big event this week, say for an example, we had non-farm payrolls. It's very likely they're hedging because it's non-farm payrolls, but we're going to see a market maker move even if it wasn't non-farm payrolls. And so we wouldn't know for sure if they're hedging because of an event or if they're hedging at all, or if it's just a part of the OPEX on the week. So just a bit of a warning. I try to give it every OPEX, not to lean too heavy on that market maker move signal, especially triple witching. That's one where we really seem to have issues with it. All right, we are above the weekly pivot. And so far today, we're above the daily pivot. This is an MDP. It's a missed daily pivot. It won't count today, but it will count tomorrow. Today's pivot higher, opened higher than yesterday. That's bullish. Price opened above it. That's also bullish. And for us to hit this pivot, we would have to get back inside of Friday's range, close the gap, get below Friday's close, and then come down, get inside the channel, and hit that floor pivot. Now, we can do all of that, and markets generally hit their pivot 80% of the time. So if you want to look at it from one direction, we have an 80% chance of hitting this line by the end of the day today. But those statistics on what we have done in the past leaves open the idea that 20% of the time we don't go down and hit that line. I'd argue that during the 20% of the time that we don't go down and hit that line, it's probably due to high volatility conditions like we're in right now, and that we shouldn't expect to hit that line consistently in market conditions like this. It is bullish that we're opening for the week above the weekly pivot. We really want to keep that. We don't want to see that challenged in any way. So if we do get inside of the week's channel, then the base case argument is we will target the weekly pivot. And if we break through that, then we target the low end of the pivot channel. And then if we get outside of that, it's game on to the downside. But if we get in this box, we'll target the line. It is a bit of a wider floor pivot channel than what we were looking at on Friday. A wider channel implies that if we break out, it doesn't stick. Just keep in mind, these channels don't make price do anything. And we've already got a breakout, and so far it's holding. Last week's point of control really close to 53.92 cog line. It's right underneath us. If we do fade to the downside, we'll look to see if there's any unfinished business around that level. 53.87 or 53.92 cog is right in that spot. Below that and below 5,300, we've got another speed bump. Then we've got a deeper air pocket down into 5,000. And generally, if we moved through that zone really fast the first time, we didn't leave much footprint behind. So we got that shallow zone, and we can move back through that same area relatively easy because we didn't leave anything behind last time. We got a gap to close overhead, and then we've got point of control from 2 weeks ago, 5640 area. $10-day, 30-minute volume profile with TPO. The TPO has already moved down. 5292 cog line. It's this collection of volume. So unless we build out one of these other levels, it's very likely we're going to see the point of control also move down there. We'll start getting into the candles that made this point of control sometime late tonight or into tomorrow. So if we start wiping those candles out and we start building out at one of these two levels, then that's enough to bring the point of control down. It'd be good if it matches the TPO's point of control so that it will be underneath us. If it lands at 5,400, that's kind of close, but it would still be underneath us at this point. And if it lands at 55, then we've got more of a problem. And that's basically last week's high. So a lot of volume and perhaps some unfinished business at last week's high could be a bit of a struggle to get through. We have a VPOC from Friday, 5394. So if we break back inside of Friday's range, we get the gap closed. We have that level to get through if we're going to go any lower than that. The base case argument on Friday was that we likely hold the line and don't really go anywhere because we were looking at a short week and a lot of risk going into the weekend. And we ran up to test that logic towards the end of the day on Friday, but it held. The idea was sound. We didn't really go anywhere on Friday, but we did put in a lot of work to have that point of control up there into the close. The last 3 hours of the day really just got a lot of work done there. So we want to keep that level. We don't want to get back down inside it. Don't really want to get close to it, likely see it turn into gravity and we just melt down into it. We're still 2.5% below the 10-week, working our way back towards it. That's far enough away that we're not looking at any sort of gravity or any pullback towards the 10. We're not seeing extreme moves at this point, just nice and healthy, grinding our way back in the right direction. .2% above the 10-day. We should be able to get closer to 2%. So we'd expect, to continue to hold above the 10-day, maybe get another 0.5% or a little more. Then we'd be near the edge of what is typical or average. We're not in a typical environment or an average environment, so it wouldn't surprise if we overshoot that. If I put my mouse there, you can see there's been a lot of times that we've gotten above 2%. We don't generally hold above it for a long period of time, but we have gotten above it. And a lot of those times we were in bear market conditions. We can see back here, for an example, it was during the 2022 bear market, and we were oftentimes more than 2% above the 10-day moving average in that bearish environment. I know it may not make a lot of sense to newer traders, but that's the way it goes, right? Get some of the biggest moves in history to the upside have happened in bear market environments. So we're not moving too far too fast. It doesn't owe us a pullback. We're not out of control. And from a rotation standpoint, it sure looks like everything got a little bit of the love and attention, except perhaps energy. Sure, energy is green like everything else over a 5-day period, but energy is less than 1%, and everything else over the last 5 days is up more than 1%. Some up more than 8%. It's a bit extreme. High correlation, right? So this morning with everything up, probably easier just to look at what is not up enough or what is down. And things that are not quite up enough, metals and mining, airlines, cloud computing, home builders, bonds. Everything else is up at least 0.5% or more. So good, strong, high correlation coefficient. Everything's working as a team. If that changes, it'll be pretty easy to see because we won't have such a high correlation anymore. Whether you're using, advancing versus the declining issues, or you just go in and watch the sectors. But with all of that collective push, we're still stuck in our own Globex range that we set at 6 o'clock last night. We haven't been able to do anything more than that. So when we get into the open today, keep your eye on the headlines. Watch the 0-day flows in the options because we don't really have any of that data in the pre-market. And keep your eye on treasuries. We don't want big moves in the dollar, the TNX, the TLT, up or down. Big moves are what we don't want, right? Other than that, whether they're going up, they're going down, we should see the impact from it. If we start to see big moves, then that'll signal there's likely something bigger coming, and it could get ugly real fast. Right, Goldman Sachs is up 3% after earnings. So they were one of the big ones today that could really change the landscape in pre-market. Yeah, that was the big one I was waiting on. So until we have a reason, just expect this push to continue. We got the pullback. So now we're looking for the next leg higher. What we don't want to see now that we put in this high, we don't want to see it leave that high behind and come in and put in a lower low. We don't want to break this low. Now we can just stay here and chop in this zone. That'd be completely different. But the goal at this point is to put in a higher high to get above that 20-period daily moving average and get it a new high higher than last week's high. Simple enough, right? That's what I got for you guys today. Be careful, be safe, watch the headlines. I'll see y'all tomorrow.